Hi, and welcome back again to Tim Bigham's Big Time Options, Edges and Hedges, taking a look at UOA today, unusual option activity on Teradyne, TER, one of the kind of test systems in the semi and robotics arena that has certainly kind of followed suit with the AI mania stock finally starting to cool, but implied volatility not cooling, which sets up several trade ideas to capture the vol and look to profit from the potential and expected reversion. So let's jump in and take a look, shall we? As always, we like to use that fusion approach, combining fundamental, technical, and most importantly, and especially in this case, implied volatility analysis. So here was the scan from, in this case, Thursday, right? You can see Teradyne right near the top of the list as it traded well over 2 times the normal option volume, right? More importantly, implied volatility now at 100%, which means option prices have not been this expensive over the past 12 months ever. So the stock certainly looking for a reversion in IV somewhere along the way. We'll take a look at just how much IV has popped here in a second. As we talked about, we like to look at the fundamental analysis. So here is the valuation multiples on Teradyne. You can see price to sales has just exploded over the past several months, to say the least. Here's a 20-year chart, right? You can see what's fairly well behaved trading right around 5 times price to sales. Now it exploded to over 20 briefly, still at over 13 times price to sales. Here's a shorter term 3-year look, right? And you can see again price to sales well under 10 times, now well over 10 times. So valuations getting extreme, to say the least. You can see a 5-year PE chart, right? Price to earnings, which had pretty much been well behaved right around that kind of 25 to 30 area until we saw that ramp up with the AI mania hitting stocks, and especially TER, Teradyne. You can see it exploded and is still priced at over 65 times on a PE basis. So certainly valuations getting extreme, to say the least. The chart finally showing some weakness. You can see the stock started the year at basically just under $200, right? Did have earnings come out that were very nice beats, right? But the stock has basically well more than doubled, right? Even with the pullback we've seen here, up about 70-some% on the year. You can see the stock did pull back over the past couple of days. Now we're seeing RSI pretty much at neutral. MACD actually turned negative, right, but not egregiously so. Bollinger percent B weakening from basically the 100 level towards zero, right? More importantly, IV, as you can see, exploding here as well. Taking a look at IV, as we said, pulled off a couple charts here. So here is a basic IV chart, 120-day IV, right? And you can see what's happened over the past several days after this big run up in IV exploded again on Thursday with the stock dropping. You can see that explosion took place all across the implied volatility surface from the short end to the long end. You can see more importantly on a look back right at the beginning of June, IV on a generalized basis under 80, now approaching 110 times, a massive run up, right, of almost 50% from an IV perspective, right? The long end seeing a lift as well, which is one of the trades we'll look at. You can see again IV at the 100th percentile, meaning option prices have never been this expensive. Pulled off. Here's a 5-year chart of 360-day 70 delta call IV, and you can see how IV recently has just absolutely gone ballistic, right? Before it was kind of chopping around, trading pretty much well under 50, right, with one brief foray above it, but now we're approaching 100, right, on the IV perspective, trading at over 95 in the highest level we have seen. And this is 360-day long-term IV, taking a shorter-term 3-month look at the exact same chart, just kind of piecing it out. You can see how IV, which was trading under 75 back here, now approaching 95. So that huge lift means option price is getting very expensive on the long end, the short end as well. Here's a 90-day look at a 50 delta call, right? And you can see again just that huge explosion. This is a 2-year IV chart at by far the highest IV we have seen over the past 2 years. A shorter term 6-month look at that same chart shows that huge lift in IV. So we expect certainly a reversion on IV going forward here. So that's up for a couple of trade ideas. One is a simple straddle trade. I simply took a look going back to June 10th, right? The stock closed at 369.21, and the June of 2028, so going as far out in time as you can, $600 straddle, right? And that's well in the money on the put side, right? Well out of the money on the call side. Closed at 385.25, right? Trading at about a 75 or so, a little bit higher IV, right? Plenty of time decay on that one as well. Fast forward to Thursday's close, the stock closed virtually at the same price, 12-cent different, but because of that huge lift in implied volatility, right, that same straddle, right, now trading at 438.75. So did a quick comparison here from back then till now. June 10th, the stock closed at 369.21. That January of 2028 600 straddle closed at 385.25. 590 days to expiration. You'd be 4 deltas net short, believe it or not, selling that put that's deep in the money and that call that is well out of the money. Why? You have plenty of time on the upward drift, right? Theta, you'd expect to make about 22 cents a day. The IV back then, as we said, just over 75. So your upside break even on the trade, right? 985.25, which is simply the $600 strike price plus the straddle premium received. So 166 and 85 hundredths% upside cushion. So certainly plenty of upside cushion. Fast forward to Thursday's close, the stock, as we said, down 12 cents, so virtually unchanged. That straddle jumped over 53 points, though, right, because of the huge lift involved. Days expiration, 23 less days. Normally, you'd expect time decay to lower the price of the options, right? Instead, because of the lift in IV, it exploded the price. The delta actually expanded because of that jump in IV from -4 to -17. So you'd actually be a little bit shorter, right? Even though you're selling a put, right? That is deep in the money, the $600 put, right? The stock at 369.09. But as you can see here, the delta 58 and the delta 41. So hence you'd be 17 deltas net short. But that lift in IV expands theta in a big way too, picking up 5 cents a day more, right? All because the IV is now over 94, right? Where before it was right around 77. So that expands your upside break even, right? Which is simply the $600 strike price plus the 438.75 received to over 1,000, right? Or 181% upside cushion, almost 15% more. Your downside break even, which is simply the $600 put strike price less the premium received back when IV was lower at 385.25. Your downside break even 214.75. Now because of that huge lift, right? 161.25, or picking up again over 14% bigger cushion simply because IV jumped, simply because that big option volume out there. You can take a look at the options, right? The put and the stock price, as we said, didn't move. Roughly trading just under 300 bucks, now towards 320. The call now is basically 120 bucks, right? Back then it was around 90 bucks, so a huge lift in bros prices sets up ideally. So your expected theta gain, right? Because you did have 23 days pass, you'd expect to make about $5 on theta, right? You'd expect the strangle to be trading if IV remained the same at 379.62. but it's actually at 438.75, which gives you a very nice vol edge of over 59 points. Interesting too, if you simply took a look with the stock at 457, and remember, we are negative deltas, right, short deltas, but going back to June 23rd, the stock about, 60, 70 bucks higher, right? That straddle was actually still cheaper because IV was lower, was more elevated than back here on June 10th, right? But still not at the levels we're seeing the extremes, right? The highest IV level ever on the options, right? So certainly makes sense, I think, to consider selling the straddle, going out and simply taking advantage of this huge spike in implied volatility. A couple other ways to do it is the strangles, a little bit shorter term if you'd like. Here again, going June 10th as our kind of comparative date, right? This is the November shorter term, right, of this year, 300, 450 sell strangle, right? And you can see back then it closed just under $100 and trading at just over an 80 IV. Fast forward to Thursday, that sell strangle exploded to over 110, right? With the stock virtually the same price. Why? Because of that huge jump in implied volatility. So our comparative here again, June 10th, the stock at 369.21, the strangle 98.25, days to expiration 163. You'd be 22 deltas net short by doing the trade, right? 45 as far as the negative theta because the IV was at 83.45. So your upside break even, which is simply in this case the 450 strike price plus the 98.25 received, right? 548.25 or just under 50%. Fast forward to Thursday's close, the stocks we said about the same. That strangle exploded though over 12 points, right? Even with time passing, right, which should, and this is a shorter term trade, right, lower the price of the options, right? But the options got much more expensive because of this huge lift in implied volatility of over 16%. Also notice the delta actually increased a few deltas, all because of that lift in IV. Theta increased as well too because the price of the options increased and time passed, so you have more time premium heading your way doing the trades now versus back then. Bigger upside break even, well over 50%. Downside break even back then, a little over 45%, now approaching 50%, all because you saw this huge jump in implied volatility. Interesting to note too that if you went out and went 10 points further out of the money on both sides now versus back then, back on June 10th, selling the 300, 450 sell strangle, right? Just under $100 now, selling the 290, 460. So 10 points more cushion, right? With a bigger net credit, and you also had all that time passing, right, on a shorter term trade. So certainly you can do one or the other, get a bigger net credit for less risk because there's less time because of the jump in IV, or get a bigger cushion and a little bit more credit simply because of that jump in IV. Another sell strangle we're considering certainly is going out to January of 2027, selling the 400 put, 600 call. So the put in the money, the call well out of the money, right? That was trading right around 140 bucks or so back on June 10th. Fast forward to Friday with that huge jump in IV that we talked about, right? You can see that same sell strangle selling the Jan 400 put, which is in the money by about 30 points or so, and then the 600 call out of the money by about 230 points, right? Now trading at over 160, so under 140 to over 160. Why? Because again, that huge jump in IV. So again, the comparative June 10th, that sell strangle was trading at just under 140 bucks, 219 days to go to expiration. You'd be 10 deltas net long because you're selling an in the money put and a way out of the money call, right? So fairly more neutral, right, Then the other one, which was a little more bearish, right? Theta or time decay heading your way by selling at 37 cents a day. IV just under 80. Your upside break even, right, is simply the short strike price plus the premium received. So we're short, in this case, the 600 call, right, plus 139.85. So our upside break even till January of next year, 739.85, over 100% upside. But on Thursday's close, because of the lift in IV, right, options exploding to the upside, right, that sell strangle actually got to over 160, even though we had 23 days peel off, right? The delta now is simply two deltas, net long here. So getting it certainly more neutral, right? So the delta's lowered simply because IV expanded, theta increasing in a big way, with huge positive for selling these. You'd be 48 deltas, or thetas, I should say, negative. So if you sell it, you receive that in time decay, all because IV now well over 90 before just under 80. Your upside break even expands right to over 760 now is the upside break even point, or over 106%. So a nice 5% increase in your upside break even. Downside break even, very similar move, right? 260.15 back on June 10th with IV at lower but still high levels, and that huge jump in IV expands your downside to give you a bigger downside cushion, right, of over 5%, give you a very nice vol edge of over 30 points. And again, you can do a similar thing here, which is comparative going back to June 10th, right, the 400, 600 we just went through, right, trading at just under 140. On Thursday close, the 386.20, 20 points further out on both sides, right? You can get a bigger net credit. So you have a little, certainly, time passing, right? 23 days. You have a bigger cushion, right? And you have, a bigger net credit. So certainly this makes sense as well. So that's how we go about looking to identify trade possibilities here at Big Time Options. But as we always like to say, trading is all about probability, not certainty. Make sure you position size properly, right? Make sure you know where to get out before you get in. And sometimes on these trades where you're looking at IV at the highest level we have ever seen, right, on these stocks, sometimes you just got to say, what the F, and go for it, right? Because we know this ends badly, especially on IV, which inevitably will revert. So until next time, as always, here's the good trading. Take care.